Hi, I'm Elsie Tham, Senior Fixed Income and Client Portfolio Manager. Now, back in June this year, Saudi Arabia, the world's top oil exporter, announced further voluntary oil cuts of 1 million barrels per day. This decision itself caused Brent crude oil prices to soar by as much as 33% since May. Unfortunately, this sudden spike in prices resulted in a rise in global inflation throughout the third quarter of this year. This can be very obviously seen in the US, where headline inflation rose to 3.7% year-on-year in August, marking its second consecutive rise since the previous quarter. This rise in inflation raised a lot of concerns, prompting the US Fed to raise interest rates for the fourth time this year by another 25 basis points. The Fed has since reiterated its higher for longer stance, indicating that policy rates will be kept high for an extended period in order to bring inflation back to target levels. Unfortunately, this narrative of higher for longer had a negative impact on the markets, causing significant dip in risk sentiment. Both the equity and the bond markets fell. The US S&P 500 index plunged by 4.9%, while the 10-year US Treasury yields rose above 5% level, a level not seen since 2007. Turning back to Malaysia, like many other geographical, we are feeling the effects of the global economic slowdown. However, there are positive developments to offset this impact. A reduced external demand has affected our E&E exports, which form a significant part of our total exports. Despite this, our tourism sector is bouncing back, with visitors' numbers steadily recovering and almost reaching pre-pandemic levels. Apart from that, Malaysia is also very actively investing in a range of transformative infrastructure projects such as the LRT3, ECRL, My Digital 5G, Pan-Borneo Highway, and the Johor RTS that will hopefully bolster our economy. Furthermore, Malaysia continues to attract strong FDIs from overseas. Companies like Tesla, Texas Instruments, and Infineon are expanding their operations here in Malaysia, indicating their confidence in Malaysia's business environment. To strengthen our fiscal position, subsidy cuts have been announced in the latest budget. This will help us reduce the fiscal deficit to 4.3% of GDP in 2024 and later to 3.0% by 2026. Now, in summary, we remain cautiously optimistic about the local equity market for the remaining months of this year rolling into 2024. While we do anticipate some catching up with regional peers, we acknowledge that global equity markets may experience high volatility. Now, for the local bond market, we do not expect any further increases in the overnight policy rate by Bank Negara Malaysia. This is very likely to limit significant upward movement in MGS yields. We do hold a positive outlook on the local bond market over the medium term. However, in the short term, movements in the MGS will be influenced by trends in the US Treasury market, which may bring about volatility and yield spikes if US Treasury continues to experience a sell-off. Thank you for watching Malaysia's Market Update. Stay informed and stay tuned for more updates.